make you just remind you to keep your mics on mute when you're not speaking. And we will start with Cap Trust. Mike was prompt and ready to go to talk about our defined contribution plan
Trustee
and the
Martin,
quarterly. Oh,
I
sorry, we need to call
apologize.
I skipped you,
May
Beth.
I
I'm
call the
sorry.
roll? Thank you.
Yes, I'm
Um,
sorry about that. Go ahead.
Trustee Martin,
Yes.
Chair Riley,
Yes.
Trustee McMahon,
Yes.
Trustee Moore.
Yes.
Thank you.
Excellent. Thank you, Beth. And without
Well,
further ado, I'll pass the meeting over to Mike.
thanks,
Barry,
Kelly. Well,
Peter.
I was hoping the roll call was going to save me because Barry was supposed to kick things off for us here today, and I'm not sure if he's on the.
I like it. It's just
He
one
is. It did save you.
o'clock.
It did save you.
Oh, and Trustee Baldacci's here too.
Good morning.
I don't
Good
think I was
afternoon.
late.
Morning.
Well, I'm gonna kick things off. As you know, we typically do topical spotlights, things that are happening in the marketplace. During the first review of the year, we always think about predictions. So we'll talk a little bit what we're thinking in terms of legislative or other matters that might take place in 2026. I'm gonna do the topicals. I'll do the market, then turn it over to Mike to talk about the University of Maine program and specific funds in the plan. So, without further ado, the first page we're looking at is just the fiduciary update. We've talked about this in the past. Any employee that made now over $150,000 in 2025 over age 50 and is doing a catch up, that catch up must now be in Roth. So that's a new provision that was mandatory effective in 1/1 of 2026. On the right hand side we're not going to go through this, but these are some of the new limits based on the 2026 retirement indexed limits. So we've done this in the past. If you think about, what are things that are happening in the marketplace in terms of legislation, litigation, fiduciary solutions, or participant outcomes, we want to go through what we anticipate to be more hot topics in the coming year. So I'll start kind of left to right and then top to bottom. Legislatively, the Department of Labor guidance and rulemaking, one of them, as you all have seen, and we're talking about that today with ESG offerings. The Biden administration was much more kinder and gentler, so to speak, with respect to ESG offerings. They certainly, you could use ESG as a guide in the decision making process. However, it remains that when you evaluate funds, you must use financial factors. We Cap Trust have always used financial factors alone, but we would anticipate more kind of going back to the former Trump administration in terms of the nature of the ESG provisions. At the same time, there is much more, I guess, positive thoughts on using alternative asset guidance. So if you think about alternatives within the defined contribution plan, we do think this is a long way off. You think about some of the private equity funds, some of the reasons why we wouldn't offer that is certainly liquidity. A lot of those private real estate type offerings are not fully liquid and they're very expensive. So we don't anticipate having applicability in participant directed plans, for the foreseeable future. Where we could see it is in target date funds. So if you have a target date fund that might invest in a sleeve of alternative assets, we're not necessarily convinced that Vanguard is going to do this anytime soon, but that could be where we would see some applicability in participant directed plans that you have. The other thing, the Savers Match, more to follow on the Savers Match. And yes, there is a Secure 3.0 that is being discussed on top of Secure 1.0 and top of Secure 2.0. So certainly something to think about in the future.
And on the ESG, if I can just jump in for a sec, I know that there's been a lot of questions around ESG socially responsible investing in general. So you probably saw on the agenda, we do have a specific item, educational topic that we're going to cover later. And just thought I'd take a minute to introduce Pete Ruffle is on the line. Pete is a member of the Cap Trust team, specifically the investment team. So Barry and I were really thrilled that Pete was available, and he's put together a really nice educational presentation on ESG that we'll cover in a while, just in case there are additional questions there.
Thank you, Mike. Sorry, Peter. On the litigation front, as you all know, you're a non-ERISA plan, but we do look into, what are the things that are happening in the litigation front. The Cornell case is really interesting. In essence, they have lowered the bar for plaintiff's attorney to simply allege a prohibited transaction. A prohibited transaction could be as simple as paying a record-keeping fee within a defined contribution plan. There's exemptions for that, but the bar in the Cornell case, based on the Supreme Court ruling, was lowered. So we would anticipate more litigation going forward until the House and the Senate look at a more kind of reasonable path going forward. But it certainly lowered the bar. In addition, we're seeing some more recent lawsuits with capital preservation. If you think about 5 or 6 years ago, when money market funds were really much at was pretty much at zero, there wasn't a lot of discussion about the difference between a fixed account like TIA traditional and a money market fund. But as the Fed has raised rates over the course of the last 5 or 6 years, now starting to lower them, we've seen a disparity between money market funds and capital preservation funds. So we've seen some suits saying like you should have invested in a money market fund now instead of a stable value because of their performance stream. On the bottom right, participant outcomes, TIAA, like most organizations, is using AI. We think ultimately it's a good thing. The more personalized you can make their messaging in terms of the individual faculty and staff member, we think that's really a good thing. So we're seeing more and more introduction of AI across the board. And then following on the bottom left, fiduciary solutions, the target date fund managers, we're seeing not only some managers looking at alternatives that we just talked about a few moments ago, but also incorporating retirement income into those target date funds. So as that comes to fruition, we certainly will bring that back to the trustees here. The other thing on target date funds is, we've seen over time, when these were originally, put in place, the disparity between the equity and fixed income portfolios were pretty dramatic between organizations. Over time, as we've gained access to more information, we have seen the disparity between the equity allocations of target date funds narrow, pretty precipitously, especially over the last probably 10 or 15 years. You can see now in 2024, most of the glide paths start with a 91% allocation. And I see there's a question.
Yeah, can just back a slide if
Yeah.
you don't mind. On the Cornell case
Yep.
and the ripple effects, did you mention that there's legislation in Congress to fix certain aspects of it? And can you explain what you know a little bit more? And I can do my own research, and then I have a follow-up question.
There's discussion on that. I'm not sure we have anything to add other than that there's recognition that there needs to be a fix to this.
Okay. It might be Kelly or Trish, even Ryan, good to have a discussion a little bit more from the fiduciary trustee standpoint of what we, are we looking at the right markers? Do we have the right kind of processes in place? It seems like maybe it's opening the door to a lot of lawsuits, but I just want to make sure from our standpoint that we have things in order.
If I can just weigh in on that from CapTrust perspective, I mean, one of the things that the Humane system does, which is really admirable, is that while you're a plan not governed by ERISA standards, you follow ERISA standards as a best practice. So, if you do look at where courts have ruled on some of these fiduciary lawsuits, it really does boil down to, do you have a process in place? Do you follow that process? Do you document that process? I mean, that's something that, we feel like the Humane system has done very, very well for, well over 10 years now, above and beyond the standards of most non-ERISA plans. You also do have protection by being a non-ERISA plan. If you look at most of the lawsuits have been filed under ERISA. Now, that doesn't mean that at some point they won't devolve, and, ultimately you'll start to see non-ERISA plans targeted just as fiduciaries. But, we think that the University of Maine system is really doing everything right above and beyond, certainly what is required of a typical non-ERISA plan. Again, we feel, I'm somewhat biased in saying that because, part of the process is it's really what we've set up as advisors and co-fiduciaries to the plan. But, we certainly feel really good about what you folks have been doing.
No, and I think that that's great, but obviously it's concerning when you have a lowering barrier to getting certain things through, even if we're not in a ERISA plan, to understand from the trustee perspective what we have, what we have in place.
The other thing I just wanted to point out is in the bottom left-hand corner, it is one of the things that's really driving movement from 321 to 338. So you folks operate under what's called a 321 non-discretionary contract. So again, we serve as co-fiduciaries to your plan. We are seeing massive growth in 338, which is basically where investment committees are turning over discretion to the advisor. And there have not been any successful lawsuits against plan sponsors that have gone that route. So there's a couple benefits to that. One is that we do think that it's a liability shift, and there's advantages to that. The other piece of it, though, is on the next page when Barry started talking about cap trusts, we're over $1 trillion in assets under advisement now. And so we use that leverage to negotiate lower fees. An example, if under the Vanguard target date series, we can cut under a 338 contract, we can cut the Vanguard target date funds fees in half. The problem is that relates to this CIT or collective investment trust legislation, which is also a bit of a gray area right now in terms of passage. So it's just, there's a lot of things going on out there. All that said, I think the most positive development would be if somehow there is some type of reform to dial back these lawsuits, because, frankly, Barry talked about fixed accounts. Fixed accounts, when money markets are yielding better than stable value, then plans that offer stable value become a target. And then when interest rates flip, then all of a sudden, if you're not offering money market, then you become a target. But there are just nuances to offering both as well. So it's just, I guess I go back to, I think, Humane system certainly seems to be doing everything right.
Thank you.
Barry, do you mind if I add, and Mike, do you mind if I add one thing on that? So to Elise, to your question, there is a House bill called the ERISA Litigation Reform Act. Some of this is maybe to help characterize why ERISA DC plan litigation has been so successful, is because the pleading standards for a plaintiff's attorney to allege a fiduciary breach, it's just relatively low. So a lawsuit can just make some allegations, prohibited transactions, fiduciary breaches, and oftentimes these cases don't get dismissed right at the beginning. And then an employer has to go through a very costly discovery process, so much so that their insurance provider will often say, let's just settle. You guys have been doing a great job. We can take this to court, but the effort and the time that's going to go into this, from a bandwidth perspective from your staff to what you would need to hire from an outside counsel perspective, is so exorbitant, we might as well just settle. And that's what we've seen. And the plaintiffs' attorneys have seen this be successful, this formula. And I will tell you, the new head of the Employee Benefit Security Administration, the EBSA, under the DOL, He ran his own fiduciary insurance business. It's this gentleman named Dan Aronowitz. He is very focused on this notion that plan sponsors, ERISA covered plan sponsors, are very scared and nervous to manage and offer a retirement plan, which really the effects of that could be so damning to the outcomes of everyday Americans trying to save for a dignified retirement. If plan sponsors are unwilling to step out of bounds or be progressive or add new tools that are only going to help participants, that's not great. And we're seeing a gap in retirement outcomes already. We need, and we're seeing it, the government is starting to back employers, which historically they've backed employees. There's a few things going on that we've seen where the DOL has stepped out and filed amicus briefs on behalf of plan sponsors in the past, I would say more deliberately in the past year. Really what that is them just saying they see this court case and they're reaching out to the judge and saying, based off of the guidance that the DOL has provided, based off of what ERISA allows this plan sponsor to do, they are following a process. They're acting as a prudent fiduciary. We don't see any issues. So as much as this we'll call frivolous litigation has been out there, it's starting to get the eyes of the government, and I think they're stepping in to help employers.
That's helpful. Thank you.
Thank you both. The target funds, just wrapping up on this one from the topical perspective. Again, we've seen over time as we've gained access to more information, people are living longer. So the premise is you need to have more equity exposure in retirement. We're starting to see most target date funds coalesce around a pretty tight bar in terms of the equity to fixed income exposure. You can see where that was in 2010 and through 2024. So 2024 now 91% starting in equity. So somebody just starting out at retirement 45%. So that's 45% equities, 55% fixed income, and then ultimately where they're static, their endpoint is beyond retirement 30%. So we've started to see a lot of target date fund managers coalesce around these a more kind of even types of differences between from an equity exposure perspective between the target date fund complexes. On the right hand side again, I just wanted to say, like Mike had alluded, that the CIT legislation, we are hopeful that it passes in 2026. We thought it was going to pass late 2025. Still, it has not taken place. But once that does pass, we are seeing more and more organizations looking at their target date funds, CIT versions of that, lower cost versions of that. But even Vanguard has a CIT version that incorporates retirement income. So if those do pass, we would anticipate coming to the trustees with some of that information. Good conversation. Any other thoughts on the topicals before we move on to the markets? Just as a recap, you're looking at the fourth quarter of 2025 and year-over-year numbers, so you can see what's taken place in 2025. Certainly the tariffs, the on again, off again, Liberation Day, on again, off again, the weaker dollar that really has catapulted the international interest in the international investments, weaker valuations have also impacted that. So net, we had a really, really strong year on the international front. You can see emerging markets, think China, Indonesia, India, South Korea, etc., up 34.4%. As of yesterday, we've added another 15%. So emerging markets is really, really strong on a year-to-date basis. Developed international, you think Europe, you think Germany, England, France, etc., up 32%. They've added another 9% through the end of yesterday. So continued strong growth in international markets. Even the U.S. large cap stock up 18%. If you recall, we were actually down in the first quarter, so we've come back pretty strong. And if you think about 2023, we were up 20+% in the S&P. 2024, we were up 20+%, and now we're up to almost 18% through the end of the year. Really, really strong back to back years on the S&P 500. Even fixed income, up 1.1% for the quarter, but 7.3 percentage points for the year. So really, really strong growth. What we have noticed, so far in the year, there's been a broadening of the market. So if you think about, some of the meetings we've had over the last year, we've talked a lot about the Mag 7, the Facebook, Apple, Amazon, Microsoft, Google, Nvidia, etc., that really have dominated the market. And that really is true through the end of the year. But we've seen a broadening to where I looked at performance through yesterday. The Russell 1000 growth, which is those Mag 7 names, is actually down about 3%, through the end of yesterday. Conversely, large cap value funds, think financial services company, energy companies, etc. We're going to talk about energy in a little bit here, up 7% through yesterday. So we've seen a broadening out of the market. We think that will continue to occur. Mike, if we go to the headwinds and tailwinds, like what are things moving the market forward? What are the things that are holding the market back? So I'll start with the tailwind side. Within the One Big Beautiful Bill Act, there were certainly some tax provisions that we could envision supercharging some of the U.S. business sentiment. Certainly, we would anticipate tax refunds rising pretty precipitously in 2025. So those are certainly going to be tailwinds in the market. And as I talked about before, the broadening base of the U.S. market and perhaps the international markets as well. So those are really the tailwinds. The headwinds, the AI play it's on again, off again. If we see, or if the market sees that the AI play is in the fourth quarter, or they're seeing some hiccups to the AI play, we could see a pretty dramatic downturn in the marketplace. Even today, while Nvidia met their earnings expectations, they didn't beat them by enough of a margin, or beat them by enough of a margin. So the market's acting negatively to that. So we could see this volatility persist, specifically as it relates to the artificial intelligence play. We've seen obviously tighter immigration policy, higher input costs, tariffs, etc. They're interjecting with the tax reform, so it'll be interesting to see how that plays out and how the Fed reacts to that. The Fed is anticipating probably about 2 rate cuts this year, but based on where we are at that point, it's going to be challenging for the Fed to discern exactly what the forward path is for their Fed rate decisions. If you think about, though, inflation, we had a little bit of cooling last quarter, so that's last month, so that's certainly some good signs. But there's a lot of headwinds in the future. And then just the elevated valuation, how much more run can be in some of these stocks that we've relied on over the last couple of years. So net will take it. Certainly a really strong 2025 internationally. So far, strong 2026. Based on today, the S&P probably is going to be flat for the first quarter. Any questions, comments before I turn over to Mike to talk about the funds?
Great. Well, thanks, Barry. Appreciate that. And I'm going to go through the fund lineup and talk specifically about the UMaine system plan. Barry, jump in anytime. Pete, also feel free to jump in anytime as well. I'm going to go through this relatively quickly. I want to leave, a good 20 minutes for Pete at the end to go through his ESG presentation. I know that's something that's really important. Overall, I guess I would just summarize things similar to what Barry said. 2025 was a really good year in the markets. 2025 was a really good year for the UMaine system plan as well. And that's going to be reflected, obviously, when you see the plan growth numbers, which were really just amazing, thanks to strong employer contributions, and frankly, just a market for the third year in a row that's been outstanding. Some of the market dynamics that Barry talked about have really benefited the plan. I would say especially in the target date space. If you think back to the market commentary, it was a really good year for international equities. It was a really good year for indexing. Your default choice where a lot of your money flows is in the Vanguard target date series. Vanguard continues to have a tactical overweight position to international equities. That was a huge headwind in 2025. And also the Vanguard series obviously is passive in nature. Indexing was a really good way to invest in 2025 as well. The flip side of that, though, is some of the negative, market headwinds, things like quality bias, active management really impacted some of your funds as well. That said, when we talk about funds that are underperforming, I want to emphasize it really was on a relative basis. Everything was up last year. It was a really good year, and that's reflected in the numbers. I wanted to start on this page. I won't spend a lot of time on it, but really this just goes through the structure of the UMaine system plan. We continue to have what we believe are all the right asset classes covered on both an active basis, a passive basis. And then the Vanguard target date series is your default investment choice. Again, we really view that as the foundation of the plan. And I think it's as good a choice as you possibly could have made in the target date space. One thing to point out as we kind of shift over to Pete's ESG presentation is that you folks do have two socially responsible choices in your plan right now. You have the TIA Social Choice Balanced Account, which is an actively managed option. And then not that long ago, you added the Vanguard FTSE Social Index Fund really to complement that as well. Frankly, it's unusual to have two socially responsible investment choices in a plan. It's actually the only plan that I've seen that has two so far. But that's not a bad thing. I think it just shows that you're listening to feedback. But I did want to put that in the context of the later conversation as well. We don't have any change recommendations for this quarter. We do have a couple funds that are marked for review that I'm going to talk about, but no formal change recommendations. From a plan asset perspective, you can see again, we're up to $2.2 billion in total plan assets. I won't read through this. You can see how that's spread out across the various plans. And this is where we break it down and you can see where those assets are sitting. So as I mentioned earlier, target date, obviously a really important asset class, about 18% of assets in that. But you can see the majority of that assets continue to be in the TIA traditional account, as well as some of those frozen, annuities with TIAA-CREF as well. About $473 million still sits in that. Just a reminder, that's not a bad thing. That's a big revenue driver that really, having that money sitting there really helps keep administrative expenses under control. We'd love to see where it makes sense people to move that money over into some of the less expensive mutual funds. But, I think a lot of that money is where it is because it makes sense to be there. And it also has the additional benefit of helping subsidize the administration on the plan as well. And then this is where we break the assets down a little bit further. And we just wanted to go through this and highlight the funds that are marked for review. Again, no change recommendations. We think that for the most part, the reason that some of these funds are lagging on a relative basis is just because of the market headwinds, but we'll certainly talk about each one of these in more detail as well. I will say that when you look at the funds that are marked for review, it's a very consistent theme. The theme is, generally speaking, actively managed, quality bias, focus on downside protection. These are all concepts that we think are very important. They've just frankly been out of favor for the last few years. It's been a market, that's really been driven by risk on, a handful of names, no real concern about fundamentals or quality. That's all going to change at some point, and that's why we think it's really important. If you feel like you have a good manager, a quality manager that follows a good approach, trying to be patient with that. This page I did want to point out, though, in terms of the exposure, you can see if you added up all of the money that's in the funds that are marked for review. In total, it's about 5% of plan assets. So we're going to kind of focus on some of the underperformers, but I do want to emphasize that where the vast majority of the money is sitting, things are really in good standing. And then this just breaks down again some of those frozen legacy contracts as well. The next several pages, you have these in your deck, so I won't go through them, but this is where we break down by contract where the assets are sitting. Again, I won't go through these in the interest of time. Sorry for the periodic pauses. I just came back from a trip with both jet lag and a cold, so I apologize for having to pause every once in a while. Excuse me. From a scorecard perspective, generally speaking, we continue to think things look okay. I know that this is a little bit messier scorecard than you're used to seeing. I always like to tell people, there was a time when I think we were all green, no yellow due diligence marks at all. And I say, it's not always going to be like that. And then this is an example of that. Again, the scorecard is one part of our evaluation process. We use a 100-point scale. Anything above 70 is in good standing. 70 to 79, above 80 is in good standing. 70 to 79 marked for review, and below 70 considered for termination. It's really just one part of the evaluation process. We think it's a good part. We think it's an important part, but it's really meant to drive conversation and dialogue, not to force any type of action. Again, really consistent theme here with the funds that are marked for review. If you look at the CREF Responsible Balanced Fund, so this is one of the socially responsible funds. This is a 60-40, 60% equity, 40% fixed income fund. Really good choice. We like the fund. If you look at the reason that this is lagging from a performance perspective, it's really about not so much what it's holding as what it's not holding. Socially responsible funds go through a series of screenings, and Pete's going to talk about that concept probably in a bit more detail. But the screenings in this case with the CREF Social Choice screened out Alphabet, Apple, and Microsoft, just to name a few names. Just by not holding those funds, you're seeing underperformance on a relative basis. And again, when we look at socially responsible funds, I do want to emphasize we're not comparing this fund to other socially responsible funds. We're comparing it to all balanced funds. And I do think that that's a very important piece of criteria. When Barry talked about the ESG regulatory pendulum, we really follow the stricter standards, even though we do certainly have the ability with current regulations to look at it differently. We think using the stricter standards makes sense. So while the fund is marked for review with a score of 78, not something that we're really concerned about. We continue to think that it's an excellent choice in the socially responsible balance space. Some of those stocks, for what it's worth, that were screened out may actually be helpful as we see market rotations. JP Morgan Equity Income, this is a fund that has been marked for review for a couple quarters now. We continue to really like the team, really like the approach of the fund. If you look at, again, kind of what the fund is doing, it tends to be a more defensive choice. Definitely has a quality bias, definitely has a dividend bias as well. That result served investors really well in the last down market. In 22, the fund was in the top 20th percentile, showed really good downside protection. Year to date, the fund is doing fine. It's up about 6.5%. It's in the top 50th percentile. I think when you look at this fund, you could argue that it's really one really bad year in 2023 when the fund closed the year in the 91st percentile. That's really dragging that score down. This is a fund that, again, we continue to like the team, the approach, the discipline. It really has just been a fund where stylistic headwinds have worked against it. And again, we think it makes sense to continue to show patience with this fund. Once that fund slips into the considered for termination, if it were to do so, that doesn't mean you automatically terminate the fund. Again, that really is just a trigger for additional conversation. Your short-term performance has been encouraging. Last year, for what it's worth, the fund in absolute terms closed up 15% and was just below the 50th percentile as well. So no huge concerns there. Continue to have a hold recommendation. And then as we jump down to the other two funds marked for review, Victory Sycamore, established value. This is the one fund I would say there's a little bit more concern with. I mean, they've certainly been dealing with the same type of stylistic headwinds as the other funds, quality focus, downside protection. But from our perspective, they really haven't delivered the downside protection that we would anticipate with a fund of this nature. In addition to that, there's been an announcement that the manager, the primary manager on the fund, is going to be retiring in April. So while we continue to, recommend holding this fund, this is a fund that I do suspect next quarter we're probably going to want to look at some alternatives to. All that said, year to date through yesterday, the fund's up almost 9.5%. It's just outside of the top quartile. It's only about 1% of total plan assets, so it's a relatively small holding. And it is a fund that, again, had one really bad year last year that's kind of dragging those numbers down. So this is the one fund I would say that we probably have a bit more concern about in terms of the marked for review funds, but not to the point where we're ready to make a change recommendation right now. Excuse me, very sorry about that. And then finally, MFS Midcap Growth, you can see scoring a 78. Very similar story here. Quality focus. This is another one of those funds where, to some degree, it's penalized for what it didn't hold. They really missed an opportunity with Reddit in that mid-cap growth space. But in addition to that, there's some communication service holdings that were really the biggest detractor, AST Space Mobile being the biggest one there. We are huge fans of MFS in general. We continue to really like the MFS Midcap Growth as well. But it is a fund, frankly, it's struggled last year and this year as well. It just the stylistic headwinds, again, not that we think they're doing anything wrong. Yeah, Jack, you have a question?
Yeah. With respect to the previous fund that you just reviewed with the manager leaving and a blip a couple years ago, is there any way to, it seems like it'd be prudent to be a little bit more proactive unless they have outlined a new manager that you feel comfortable with or you see that coming. You would think that those discussions would happen and we would know whether we need to leave before the manager leaves. I know a lot of times when a tenured manager leaves, it's just like joining a new fund, and you really need to not give it the blessing and assumption that everything's going to go on the same tangent.
Yeah, it's a great point. I mean, one thing I do think is important to note is that, he's the lead manager, but has a pretty deep team underneath him, which we do really like. And we've always liked Victory in general. That said, this is fairly recent development. I get what you're saying in terms of, maybe being a little bit more proactive on this. But it is a fairly recent development. So I would say, we're prepared to, have some alternatives to consider next quarter. If you think it's more urgent than that, then Jack, there's no, mandate that we wait a full quarter either. I mean, we certainly can pull together some comps and we can, address this off cycle, if you will, away from the regular quarterly reviews.
Yeah, I mean, I think it's worth at least making a conscious decision to give the next generation a blessing or not.
Okay. Yep. No, that's fair. So what I can do is provide some additional insight as a follow-up to this meeting, on Victory specifically, but again, on the manager change and what that succession plan looks like that they have in place.
Okay. Thanks, Mike.
So I just want to make a quick note there. And then finally, you can see MFS intrinsic value. The 5-year performance is a little bit off. The fund is in good standing with a score of 88. Absolutely no concerns with this fund, coming off a strong year just outside of the top quartile. for what it's worth, up 33% in absolute terms. So it was a really good place to be in 2025. So overall, again, this certainly, not trying to sugarcoat, certainly some underperformance amongst some of your actively managed holdings. None that we're really overly concerned with. I would say the one caveat there would be with Victory. That's the one where I would say we probably will be looking at some alternatives next quarter or perhaps sooner, depending on how you feel about the follow-up information. The balance of your review looks really good. Again, the Vanguard Target Date series, it's hard to feel like you could have made a better choice there. They just continue to do really well in absolute terms, really well in relative terms. The tactical positioning of the overweight international has been, clearly additive. Last year, they were really top quartile across almost every single vintage except the retirement vintage. So, no concerns there. And then, as Barry mentioned earlier, under capital preservation, you really offer the TIA traditional. The Vanguard money market is really not an active option, if you will. So, that's one that is used more of it as a holding account than anything else. And then finally, you have the full suite of Vanguard index funds. So if you have investors that are really committed to low cost investing, but they don't want to follow the asset allocation strategy and glide path of the target date funds, you can create a really well diversified, extremely low cost portfolio using the index series. And then finally, wrapping it up, we do kind of distinctly score the TIA real estate account and the TIA global stock account separately. They don't fall into kind of a clean category to allow us to score them the normal way. So here we're just looking at qualitative items, quantitative items, and obviously performance, and we feel good about those investments as well. So overall, again, I think it's been what I would describe as a really good year for the UMaine system plan. Certainly in absolute terms, everyone did really well, regardless of where they were invested. But, I particularly I'm a big fan of target date investing. I think the more assets we see flow into there, the more you're going to have participants who are, well diversified on an age appropriate basis with automatic de-risking at a very low cost. And, to me, that's 95% of the investment battle right there. So, I feel like I talked really fast, a lot of topics there. So I'll take a pause before I hand it over to Pete, and you can talk about ESG specifically. And Kelly or Tracy, I didn't know, did you want to kind of tee up the ESG conversation at all, or do you want us to just kind of launch right into the presentation?
I'm sorry, Kelly, you came off mute.
No,
Sorry.
go right ahead.
Thank you. I just comment that we've heard from the UMaine faculty, Senate, and from also another individual during a board meeting requesting some fossil fuel alternatives in our plan, and all that information is in the materials, and we've asked you to do some research in that area, talk about fiduciary responsibilities, what options are available to us, what options are already in our plan just in general. So that's just a quick background for you.
Okay, thanks, Tracy. And Pete, do you want me to share my screen, or would you prefer?
Yeah, go ahead.
Yeah, go for it, Mike.
Okay.
And I want to tee this up to the first page as we talk. I think we've touched on some of this already, so I'll be brief, but we use ERISA as a guide in the decision-making process. We see that as a best practice in the market. Many of our other university system plans do the same. You do the same type of process. And if you look at ERISA, it's a process-driven legislation. So if you go to page 2, Mike, since we are using ERISA as a guide, as a best practice, there are 6 duties that we must follow, which is duty to be prudent, which is really about establishing a prudent process. We document those, we talk about them. We have a scoring methodology. We review the funds each quarter. So it's really developing a process in order to properly evaluate funds in the plan. In addition, duty of loyalty and impartiality. The biggest thing here is making decisions exclusively in the best interest of all plan participants and beneficiaries. So we are tasked with creating a menu of funds that through a risk return profile that individual participants can elect to invest in. So that's part of the diversification. It's also part of loyalty and impartiality. And the other ones are just more monitoring and supervising. But those are really the key things that we're talking about today in terms of what the fiduciaries, the trustees are tasked with monitoring this program. So with that, I will turn it over to Peter.
Mike, if you want to flip to that next slide. So we wanted to start with a little bit of landscape here, and maybe before we dive in, I do want to clarify that when we say ESG, that's not always synonymous with fossil fuel free. There are plenty of funds that are managed under the guise of being environmentally, socially governance friendly, but don't actually toe the line of saying we divest from all fossil fuel companies and associated activities. And we've seen that kind of change over time. I call back to probably the Obama administration, and there was a bit of ESG friendliness that went into the Trump administration in 2016, and they had a DOL rule that kind of shut all that down, followed by the Biden administration that was a little bit more friendly, giving more latitude to ERISA covered plan sponsors to consider ESG factors when selecting an investment. And now we're second Trump administration expecting kind of a reverse course here, a bit of a ping pong match. Throughout that time, asset managers were almost flexing a little bit to meet investors in the middle. During 2020 and post, there was very much an interest to invest and align how you invest with your ethical views, whether that's faith-based or otherwise. And a lot of asset managers were melding their approach again to find potentially new investors. And what we were seeing were asset managers that would change their fund name from XYZ large cap value to XYZ socially responsible large cap value, greenwashing, if you will. A lot of that has changed. The SEC has came out with a names rule that is going to enforce certain asset managers that use those types of verbatim to kind of follow a more deliberate process. I'll give some credit to the fact that the current administration has put a pause on some of those rulings, but by and all means, what we've seen is a lot of asset managers reverse course, take out ESG from their naming conventions. And what we've been left with is probably more the true sole survivors of people that actually are mission-focused investors or really toe the line and follow the rules of what they're saying when they're saying they're an ESG investor. So when I say all that, when I look across the universe of U.S. domiciled mutual funds, there's a much more limited amount of asset managers that call themselves ESG today than what they did back in 2020. And even since then, even more so, the amount of managers that say they're fossil fuel free has shrunk as well. I can remember talking to an asset manager in 2020, asset manager named Parnassus, and they were talking about their strategy and their approach and their ESG layering, and they were fossil fuel free. They were deliberate about that. They said that. And then in 2021 and 2022, the energy sector was ripping and roaring. And all of a sudden, their peer relative returns looked bad. And so they changed the tune of their song. They said, well, Chevron and Exxon, yes, they are fossil fuel companies, but they're the ones that are investing in renewable energy. So we're going to, by ways of shepherding the new world of renewable energies, we're going to invest in them. And it was just playing catch up in a way. And so, again, muddying the waters, a lot of subjectivity to this approach of ESG investing in the United States. There's more uniform and standards in Europe and less so here, and especially how it continues to be a politicized thing. I don't think we're going to get clear answers in the future. So what this page was meant to really do is give you a sense of if we were ever to consider and identify a fossil fuel free company, strategy fund, what's out there? And if we put something in place, what's the opportunity for us to remove it and find something that's similar? And it's limited. This little mosaic on the bottom left chart is just representing the amount of individual strategies by asset classes. So the large cap blend, for example, there's 12 strategies today. When I look even at which of those strategies, how they've done on a peer relative basis, there's about 4 of them, one of which is the one in your plan. There's about 4 of them that have outperformed half of their peers on a rolling 3 and 5 year basis, some of the metrics that we use from a scoring system perspective. So it's a finite universe of options that are available. And I will underscore again what I just said there, which is today there is a deliberate fossil fuel free fund in your plan, and that is the Vanguard FTSE Social Index. They weren't always fossil fuel free. They made that change in 2020, and they've stuck to their guns since then, and they continue to do so. But this is just giving you a sense of there's about 24,000 mutual funds out there. That's including share classes. There's about 106 unique strategies that say they exclude fossil fuel. And of those, about half of them have more than $500 million in assets under management, which is a threshold that we would consider an asset manager from being boutique to one that is actually appropriate for UMain's retirement plan. And then even below that, there's only 21 strategies of those that have a 5-year annualized category rank within their peer groups that is in the top 2 quartiles. So you can see to some extent, these funds that have applied some of the screening methodology haven't always held up against their peers. Maybe go to the next page, Mike. These next 2 pages are really just all the funds that are available in your plan today. It's fund name, asset class. Third column over is whether or not by prospectus they say they're excluding fossil fuels, and then the fossil fuel involvement. The excludes fossil fuels, that's a binary thing. Does their prospectus to investors say anything about the explicit nature of them excluding fossil fuel companies? And then that fossil fuel involvement is a metric provided by Morningstar. There's a lot of different data providers out there that provide a similar analysis to this. MSCI, S&P, and others. We use Morningstar. Again, this is all pretty subjective. And I say that because when we were prepping for this, we talked about the fact that by Morningstar's screen, they say no fossil fuels. By a publicly available website that maybe your employees might use from time to time called fossilfuelfreefunds.org, where you can go in and find funds that say or how well they align with fossil fuel free initiatives. They actually show 0.44% involvement for Vanguard FTSE Social Index. And a big portion of that is Blackstone. Blackstone is a private equity asset manager that's publicly traded. They do a lot of both private credit and private equity investments. And this one kind of data provider, if you will, basically says Blackstone's investments, it's got tendrils in so many different companies. Well, bring it all together, the amalgamation of it, they have a certain threshold of revenue that comes from fossil fuel involved companies. So all that is to say that even as much as maybe the trustees are purposeful about this, it meets all the fiduciary standards of selecting an investment, and you guys know that characteristically it excludes fossil fuels. There may be a data source out there that, again, says otherwise. This goes back to the nature of the fact that there is not uniform approaches in the United States about how we consider what is a threshold of fossil fuel involvement or otherwise. But today, this is by prospectus. If I was an investor, this is the language I would read if I looked at the fact sheet or went on Vanguard's website and tried to understand what I'm owning. This is some of, the prospectus is much longer than this. I just called out the specific language that I thought were going to be matter to the trustees relative to what they're doing today. I'll remind you, Vanguard FTSE Social Index, it's a passive fund. It tracks an index. It's a FTSE Russell socially responsible index. We score it on an active basis. Why? Sort of what Barry and Mike were talking about before from fiduciary responsibility and the onus that we think that we need to review a manager like this. Just setting a standard of, hey, how well do they track this benchmark? We don't think is the appropriate way to evaluate a fund that has some type of ESG flair, especially in today's day and age. So we apply it against our active screening methodology, against peers, and it has done consistently well, which is why it continues to be a good place within the menu. So I can read some of these bullet points, but if you look at the kind of the bottom bullet points, what it says, the target index excludes stocks that of companies that are involved with any of these types of activities: nuclear power, exploration and drilling, production, refining, marketing of petroleum products, oil field services and offshore platform support, mine, process, market coal. There's a lot of different industries that their policy covers that the Vanguard FTSE Social Index by and large does not invest in today. So I'll pause there.
Thank you, Peter. Elise?
Trish, do you want to go first?
Go ahead.
Yeah, I mean, so I wasn't here, obviously, when any of these came to be. And it seems like, we're on the right trajectory as far as, obviously, we've done a lot of work to minimize our exposure. But what you said, Pete, is kind of disheartening in that you can be moving and then these all of these goalposts can change.
Yeah.
So I don't really have a question, but I appreciate you bringing those things up. I had never, it was just all new to me from a discussion point, and I think it is something, it is still our task. So I think it's just figuring out, knowing all of these things that we can't control, how do we continue this work?
And maybe some background would be useful, because I think, and it will eventually get to a question, but in our other investments, the board moved beyond ESG and said we want fossil fuel we want to be completely fossil fuel by 2030, and we're moving rapidly toward there. We were able to find a number of fossil fuel free strategies in that investment world that we've invested in. There's an index that I've forgotten, Kelly Regan can tell us, but I've forgotten the name of the index that she uses to identify those fossil-free funds. So I guess my question is, and recognizing that this is a process, we appear to have faculty who want the ability to invest in truly fossil-free funds. And I think that would be defined, Pete, as those that meet that website definition. As compelling as the Vanguard definition is, it would probably be that index. And there's our Kelly Regan expert who can tell me all the right names for things. So I think what we're trying to move toward in this, recognizing that we have a different fiduciary responsibility around our defined contribution and our retirement funds, we're trying to provide a very clear, clean option for those who wish to invest in truly fossil-free initiatives. And I'm trying to figure out, how do we get there?
Well, it is worth mentioning, though, that we do have the self-directed brokerage account. So if somebody really does want to invest in a fossil fuel free manner, we have the ability today within the brokerage window to do so, in addition to the one fund we're talking about in the core menu.
And how would they find a fossil fuel option in their self-directed? That would be up to them to go to that website.
Yeah, to do the research
Okay.
necessary. Yeah, we could probably help them. I'm
Yeah.
trying to think, like we could work with TIA to identify some of those, but
Yeah.
we're not recommending those. So it'd be a little, we just be for more for informational purposes.
And maybe that would satisfy what they're interested in. I think what they're looking for, though, is box X, fossil free, put money there.
Mm-hmm.
What is also interesting is we've had the Vanguard FTSE Social, and this is not a political statement at all, but the Vanguard FTSE Social Index has $187,000 in it, 0.01% of the portfolio.
Yeah.
So by way of participant investments, we have not seen that take off. Maybe it's maybe an awareness or unawareness of that fund offering.
It may be awareness, who knows, or we don't identify social, we don't, maybe we need to identify it as a.
Yeah, it could be. Yeah. That could be.
Can I add a couple things here? And this FTSE fund that we just added, we did just have that approved. The investment committee did that back in December 2024, and working through TIA, it wasn't added until last March. So we're just coming up on a year of that even being available to participants. But agree, it's not really labeled a fossil fuel free fund, and it wasn't when it first started. So, but that could be a communication thing on that. But at the time, we were asked for an additional ESG funds, and so we did add that to the CREF offering as well. And just for point of clarification, Trustee Baldacci, I'm not sure because you haven't been on the committee as long, but the 3 portfolios for the university, the managed investment pool, the defined benefit pension plan, and the operating fund, those are the ones that have the guidelines where the fossil fuel goals are. And this plan is the defined contribution plan, which is participant monies. And that was part of the reason why the description on the fiduciary responsibility, because participants, individuals, employees, and retirees hold those monies and not the institution, and they're not subject to the goals of our university portfolios. And Trish, you had mentioned what is the benchmark that we use in the other portfolios, and it's the Carbon Underground 200 list.
Thank you. That's it.
Thank you. I appreciate that clarification. It is interesting. Do we have anyone who kind of chooses those to do their investments on their own right now, to kind of choose their own adventure?
We certainly have employees who do their own thing, and we have employees who engage with certain advisors, and they use a combination of the menu offering as well as going out to the brokerage window and selecting whatever they, come to a conclusion based on the needs of that individual and working with them to advise on. So they can do any number of things as far as investments using the brokerage window. There's thousands of opportunities out there, but I would say that, I don't know, Barry, if the vast majority do utilize the menu, and maybe with just a couple with the brokerage window.
To give you some indication, the self-directed account has about $105 million, represents a little less than 5% of the assets. So it is active.
But it may well be that a lot of employees don't want to take that responsibility and want to know an identified fund as the easy way to do it. And maybe the Vanguard meets that criteria.
We could definitely take a look at that. Tracy, I think when we prep for this, if you have that list, I can screen that. We can do that on an ad hoc basis going forward. Vanguard reports their holdings on a monthly basis. That might change to quarterly in the future because there's some SEC rules coming down the pike, but we could screen that on an ongoing basis.
The one that we actually have in the menu.
Yeah.
Is that what you're saying?
Yeah.
Okay.
Great.
But I do. Well, I'm sorry. I was just having a thought on that. I mean, I do agree with the earlier conversations that not all the measurement tools are the same for everyone. And so, I don't know how important it would be to screen it against that Carbon Underground list. That is a dated list because we don't pay for the current one.
Okay.
So to the earlier points, the exclusions defined and the prospectus of that particular fund state their goals. So I'm just not sure how valuable that would be to compare it to something that the institutional funds is using.
Yeah. Yeah.
But I wonder, Tracy, for the fact that, people clearly want equity to what we do with our other investments. So to that degree, it is a measure that we use for other investments. So it might be reasonable for the faculty.
Yeah, we can certainly run it up against it. I'm just saying there's a lag, but we certainly could run that up against it just to see where we stand.
Yeah.
Thank you, Pete.
Yeah. I think there's novel ways to approach this for the trustees' benefit, like certainly so, but there's a cost associated with taking a separate account, putting it into a DC plan, having your record keeper unitize it, having the record keeper create a fact sheet just so that asset manager screens out specific stocks, maybe this Carbon 200 Underground list. It's costly. A plan of your size, maybe the economies of scale might make sense. We can get there. I think what we are trying to give you some sense of is what is the off-the-shelf look like? What does the easy plug and play approach look like? And it's sparse. Even from a target date fund landscape perspective, we've seen target date funds that said they were fossil fuel free and then have since liquidated. They didn't get enough investors in it. And there's only one target date fund series out there on the marketplace today that is explicitly fossil fuel free.
So, but we've had luck in our other investments. So I guess I'm struggling.
That's easier to do in
Yeah.
a trustee directed environment, much easier to do than in a participant directed environment.
Because
Costs, participant, like how it interacts with the participant side. So on a defined contribution plan expense ratio, it
Yeah.
can come down pretty low when you're adding in these types of flavors to it and needing a record keeper to unitize a NAV that trades every single day so your participants can come in and out of that fund.
Yeah.
You add cost to it.
Yeah, Trustee Riley, this is Kelly. Hi, everyone. Pete, I thought your presentation was fabulous. Pete was showing you all kind of the universe, I believe, of mutual funds. And
Yep.
so in the 3 portfolios that you have, 1, you have the ability to use separate accounts, but 2, you also have the ability to use commingled funds. And not all those commingled funds have daily liquidity. And I think that's what Pete is getting to.
Yep, yep.
If you were to use some commingled funds, you'd want to make sure that they have that daily NAV aspect to it, and that's not
that's best.
as easy in DC land.
So I guess the question is what, where are we in terms of addressing the concerns that we got from the faculty senates? Do we say you have a individual self-directed option, you have a Vanguard option? I mean, how do we address this?
I did want to go back and just point out that already I think UMaine system from a socially responsible perspective, and I recognize that socially responsible is not fossil fuel free, but I would argue that you folks are already doing more than the vast majority of defined contribution plans by having really 2 separate socially responsible options, including one that does have a fossil fuel free mandate, and then the self-directed brokerage account as an additional option. I just off the top of my head, I can't think of any other plans, that can say that.
So maybe the issue is packaging a response to the faculty that explains those 2 in some detail so that we already have the option. And it may be that people just don't understand it. Excuse me,
Jim?
Oh, I'm sorry. Just after I raised my hand, a lot of what I was going to say kind of got said before I was going to say it. But just kind of in my dual role, kind of catbird seat position in front of a large number of faculty and staff at the university and working on their behalf in the defined contribution plan. I can tell you 2 things. One is that the very, very few of the folks that we work directly with have expressed significant concerns about specifically the fossil fuel part of it, and we've been able to find adequate accommodations for them, in some cases through the brokerage window, but in other cases just through being able to dig down a little bit deeper and let them know, using tools like Morningstar, Bloomberg, that type of thing, what they've got, that they've been relatively happy with it. And secondly, we found less and less of a need, and I think it speaks to the good work of this committee and of Cap Trust and kind of their oversight, and actually really ever needing to go through the steps of accessing the self-directed brokerage account. It's this fund lineup relative to other plans that we worked with really seems to have more client friendly, more participant friendly provisions, and as well thought out a breakout for the audience that's taking part in it that I've seen out there. So just my 2 cents, that's all.
Great. This was an amazing presentation. Really, thank you for the for all the details and all the the information. Really appreciate it. Does anybody have any other questions or concerns in regards to the communication presentation beyond what's been said? And I want to thank the people that commented too. It really added to the conversation. guess without further ado, I'd like
Thank
to
you all.
thank Barry, Mike, and Pete. Thank you. As always, great presentation. Pete, thanks for your expertise and the
Yep.
educational session. Really much appreciated.
My pleasure. Thanks for the time.
Thank you all.
See you, everyone. Bye-bye.
Take care.
Take care. Kelly, Matt, there you go, right? Queued up for the next part of the NEPC Capital Markets Review and Quarterly Performance. So
Sounds-
thanks for your comments as well, Kelly, on that.
You're welcome. You're welcome. Good to be with all of you. We'll go through markets, performance, and then we do have an asset allocation review with one recommendation coming later. So Matt will cover markets and performance, and then we'll touch on the last item, which is the recommendation on asset allocation.
Great. Well, thanks, Kelly. I'm sharing my screen. It should pop up here in a minute. So you heard a lot about the market review from the Cap Trust folks who did a great job sort of explaining 2025. So I won't go through everything here. I'll focus sort of most of our comments on the forward looking. But just to set the stage there, as I think back at 2025, I think the sort of term that comes to my head is just uncertainty. So this volatility, and it was everywhere. I mean, you think legislatively with the One Big Beautiful Bill and the sort of run up to that, tariffs, the start-stop nature there. The labor market, which had been so strong for so long, started seeing some cracks. And then, how does that play through to the Fed and the path for rates? And then, as we're all aware, we saw the longest government shutdown in history in Q4. So a lot of lack of data there. So investors in particular really had to lean on earnings, and in particular, those mega cap names, which for the most part largely delivered. So we saw those come through in returns across the spectrum. How those played out throughout the year, before we jump into 2026, just to remind everyone, Q1, we did see a little bit of a pullback. The S&P 500 was down about 4%, but then it shifted gears. So we went down a little bit more starting in April with Liberation Day, but it bounced right back and had a great quarter, up 11%. Q3, continued that same thing, but that's when we started seeing some cracks in the labor market and we got our first rate cut. And then Q4, we started seeing more market breadth come out. And that's sort of more so where we are so far in 2026. Markets are up, but we're seeing a little bit more market breadth not being just led by some of those big, AI themes there. So with that, maybe just where we are in markets today. So, valuations, no surprise, are at all-time highs here. However, NEPC here, we don't believe that to be a bubble. I mean, there's a couple signs that we would point to that maybe aren't at that bubble stage. A few of them being, just a lot of speculative IPO activity and acquisitions. That's not really what we're seeing. We're seeing that activity pick up a little bit, but it was been frozen for 2 or 3 years prior to this. You would typically see stuff like a lot of leveraged debt, or easy credit conditions. Maybe we're a little bit more in the middle of the road when it comes to that. And then typically with bubbles, you'll see some financial instability related to sort of interconnectedness. If Bitcoin, for instance, tanks 50%, does that trigger anything in the wider markets? And so far, we haven't really seen that. There's also this idea of sort of this greater fools theory, this musical chairs, as long as you're buying it, someone's willing to buy it after you, you're really not at that point of a bubble burst yet. And maybe we're in sort of a middle of the road. That's a little bit hard to tell. And probably the bigger thing as it comes to managing portfolios is just this passage of time. Bubbles tend to last a lot longer than people feel that they should. And right now we've sort of measured this as middle of the road. But if you think back early 2000s when the bubble burst, there were, people talking about valuations being high and frothiness in the market back into, 1995. And then the markets ran up for another 5 years before you really saw that bubble burst. And if you would have pulled back from equity markets during that time when those conversations first started coming up, you would have lost some of the best returns that we've ever seen in the market. So there's still some signs. Certainly markets are frothy in our view, but not quite to that bubble aspect that would make us really, truly concerned there. A couple of the other points that we have on here I'll go through quickly is just inflation still lurking. How does that play in with the Fed and the rate path there? as it relates to the Fed, that rate cutting cycle certainly has begun towards the second half of 2025 and into 2026. Roughly, I think the market's pricing in 2 rate cuts. And certainly with a new Fed chair coming in, those are likely to occur. And then finally, this wealth effect, this idea that strong equity markets are supporting more economic activity, which supports more consumer spending, which then sort of boosts more economic activity, and it's this self-fulfilling thing. This is where you've probably heard the K-shaped recovery. Much of this wealth effect driven by some of the top earners who are seeing their portfolios increase, which makes them feel better about things and makes them spend more. So we have a chart. I'm not sure if it's in this deck or not, but it just shows that those top earners are really what's driving that consumer spending that's sort of underpinning a lot of the economic activity that we've seen. So with that, let's move forward to sort of our market themes and outlook. And just to set the stage, as you may know, Kelly, myself, and the rest of the NAPC team, every year in January meet out in Boston to sort of get our heads together and come up with the themes that we feel are going to impact markets in 2026 and in the near term thereafter. The 4 that we've come up with this year being listed on this page, the first being navigating this AI froth. So as I mentioned, valuations are high. There is a lot of AI froth, out there in the market, but so far it's largely meeting the demand. The real question becomes in 2026 and beyond is, can the spending, the capital expenditures that we've seen from some of these hyperscalers really translate to some tangible benefits? Does it relate to production gains? Do we see more widespread adoption for more meaningful tasks? I think for a lot of the wider population, you're getting stuff like, can you help me write this email? Can you summarize, this report for me? Or can you get a recipe for dinner tonight? A lot of stuff that is nice and kind of fun to do. We're seeing less so in sort of taking over a lot of the meaningful tasks that really run and underpin a lot of the earnings for some of these companies. Now that may come. I think we've seen some concerns about that with the recent sell-off in the software market, but still sort of TBD there. This next one, the look to the U.S. economy. There was a lot of stimulus that came out, at least in the near term, related to the One Big Beautiful Bill and some loosening of credit, which should help things in the near term. It could also drive some inflation there. And then also with the Fed, lowering rates in this rate cutting cycle, that tends to be, a tide that lifts all boats there. So to the extent that happens, we could see sort of the start of a new multi-year cycle where maybe we don't get the downturn that everyone has been expecting for, a year or two, and it really sort of is a liftoff point for further highs. And then going sort of clockwise here into the labor market dynamics, does the AI that we talked about, does that drive more widespread unemployment? Does it start taking over those meaningful tasks and you see some more headline unemployment numbers come out? We have seen some come out, but those are largely from companies that probably overhired the past 2 or 3 years. We haven't really seen it for other parts of the economy there. There's also this idea of, net negative migration out of the U.S., which by nature is going to be a little bit inflationary. And then on the AI, going back to the AI theme, this idea of sort of the productivity benefits that we could see coming from AI really benefit the capital holders, not the laborers that are part of that, which could increase that K-shaped recovery that we talked about, where the top earners that hold much of the capital are going to be doing more and more of the spending. So we could see that divide sort of, further there. And then finally, this do not fear the US dollar. We, NAPC, don't see that, or don't see really any true alternative to the dollar's reserve status right now. You look out 50 plus years, maybe something comes up, but right now there's really nothing that would take its place currently. So while there could still be some USD weakness in the near term, which is going to drive a lot of the non-US equity returns, which we saw in 2025, nothing sort of more structural that would really impact, our thinking and managing a portfolio. So I'm going to skip ahead to maybe page 17 and just talk about our positioning Given all this, how are we positioning portfolios? We position portfolios for long term, so a lot of this is going to be things that we've talked about in the past, particularly being patient, being boring, embracing the diversification, which would or should really help in environments where market breadth expands, like we saw in Q1 of 2025 and what we're seeing a little bit in Q1 thus far in 2026. Volatility was certainly there in 2025, and it's not going away as we move into 2026. So just really making sure clients understand their tolerance for tracking error is going to be important as managers are going to sort of ebb and flow with those markets. With that said, we're advising clients to maintain equity exposures at strategic targets, but maybe diversify away some of that concentration risk that we've seen in the top part of the market, those Mag 7 names. And to be clear, this isn't a sort of a new recommendation. This is something that we've been telling you all and other clients for quite some time, just given sort of that concentration with those top 7 names. And then one other thing I'd highlight here is in the middle of the page, this importance of alpha. Right now, particularly with the Mag 7 and sort of that concentration risk, betas are expensive. So when you're just buying a broad market ETF, for instance, and getting broad market exposure, it's relatively expensive relative to historic norms. This historically has been a time when active managers can add value, just being able to find some of those best opportunities in an environment that's sort of expensive across the board. But to the extent that those top companies keep running and driving market returns, and we don't see some more expanded market breadth there, that could be, an area of continued weakness as it relates to the active managers. So I'll stop there and just see if there's any questions before we jump into the portfolio performance. Okay, well, not seeing any. I'll jump into the operating fund first. Currently sitting about 230 million to, decrease of about 50 million from last quarter, all due to outflows. There was some positive performance, as you can see in that upper right-hand table there. This is the most conservative of the 3 portfolios, about a third in cash, although we are sort of in line with targets and ranges. The performance is going to be, in line with benchmarks. This isn't a portfolio that we would expect a lot of alpha, just given its allocation to cash and fixed income. So, performing sort of in range with our expectations there. There were 2 manager announcements that apply to this portfolio. Both are no action. The first one being Newton. The parent company, BNY, just announced some organization changes, just trying to integrate resources across their teams to more efficiently, conduct things like compliance, marketing, risk analytics, but it really doesn't touch any of Newton's investment processes, and all of Newton's team remains intact, their day-to-day operations, philosophies, guidelines, and so forth. So no action recommended for that Newton due diligence event. The other one, Federated Hermes, also no action. This is just some standard long-term succession planning. The retiring CIO is being replaced by the deputy CIO there, so no concerns. And then just as a reminder, last quarter, Q4, Baird was replaced with IRNM, and we'll see that in the performance here shortly. And then we have no recommendations in this portfolio, although Kelly will walk through the asset allocation here in a moment. On the pension fund side of thing, similar comments about the managers and whatnot, but currently at about 16 million, a slight decrease in assets, just all again due to outflows. There was some positive performance there. This is a more aggressive portfolio with more active managers. So all the underperformance we're seeing in Q4 of about 90 basis points is almost entirely due to the 3 global active equity managers in Walter Scott, Impax, and Lindsell Train. We'll talk a little bit more about those in detail here in a moment. Only 1 manager announcement for this portfolio, Newton, which we already talked about and had no action. And like the operating fund, Baird was replaced with IRNM this quarter. We do have a recommendation here, which is to terminate Walter Scott, and we'll talk about that, and to fund it with an ETF with the proceeds there. But as it relates to the structure and the asset allocation, no recommended changes at this time, but we'll walk through, as I mentioned, with Kelly here in a moment. And then on the managed investment pool, currently at about 412 million, slight increase. There was some outflows, but the performance more than made up for that. This, like the pension fund, is going to have a little bit more active management. So there was some underperformance here relative to the benchmark. But again, this is all essentially due to the global and international equity allocations there. The rankings, you can see below median, but this is something, especially in the long term, we would expect with a portfolio that doesn't have any private markets or has a very small portion of private markets relative to the peer group it's being compared to. Now, more recently, that would help as public markets have outperformed privates, but really that active underperformance in those managers that we'll talk about really kind of drove down some of those peer rankings slightly. In terms of the manager announcements for this portfolio, again, Newton is in this one, so no action. The one that's not in the other ones that is here is Westfield. And this is actually an upgrade from what we had them on watch, and now we're upgrading them to no action. Originally placed on watch just due to a new minority owner that came on board, and then there was also a retirement of one of their senior researchers there. And in instances like that, we like to just keep a close watch on those managers to make sure the fund has stayed stable, and healthy, and Westfield has done that. So we're removing them off watch. And then similar to the two other portfolios, IRNM was added to this portfolio, replacing Common Fund here. And like with the pension fund, we're recommending terminating Walter Scott, in this case, sort of allocating the proceeds across the US, non-US, and emerging markets allocations appropriately. And we'll talk about what that looks like for the broader asset allocation review when Kelly talks about that in a moment. Any questions before we move into some of the manager commentary? Yeah, Trish?
First of all, I like the be boring goal. That's very, very good. The Walter Scott, especially for Lisa's benefit, who's new. We've been looking at that. You've had them on a watch list for a long while. How long is that process?
That's a good question. So the watch process itself, we have no structured time in terms of how long a manager can be in watch, but it's something that we just monitor closely. So in the instance of Westfield, for instance, where it was just sort of some standard succession planning and changes there, that's going to be maybe a year plus, because we don't have really any concerns necessarily with the strategy. It's still performing in line with expectations. And so we just want to see them sort of maintain. And that's just sort of no news is good news. Maybe after a year, we take them off watch and we're comfortable there. Something like Walter Scott, that is one, going to be a little bit more client dependent. But two, we have, cycles in which we do a deep review of our underlying asset classes and the managers in those asset classes. And so with Walter Scott, we just did a re-underwriting of that strategy, in part because of the underperformance that we've seen across the board there. And so part of that process is, we downgraded them from our highest rating of a 1 down to a 3. And because of that, recommending, terminating it from this portfolio. But to answer your question directly in terms of a timeline, that's going to vary a lot more than what the succession planning type stuff is, because it's, maybe they jump back up in a quarter after we put them in watch, so we feel a little bit better about them, and we have some more meetings with the management to get comfortable with the strategy and where they see things going. Other times it can be sort of a slow burn, and we're not seeing that change that we would hope to see, and so we ultimately re-underwrite them and downgrade them as a best idea. So maybe that's a great segue into the actual managers here. Starting here at the top, the SSGA, this is a passive exposure, really just going to out or underperform depending on how energy is doing. But in absolute terms, you can see, really additive to the portfolio as equity markets have continued to run. Westfield, we talked a little bit about the succession planning there. This is one that did struggle last quarter, but it really rebounded this quarter. You can see up near the top quartile, outperforming by about 3.5 percentage points there. Last quarter, or Q3 rather, there was that junk rally that we talked about, and I think the Cap Trust folks alluded to this time as well, that really turned the corner here in Q4 a little bit as market breadth expanded. So that really helped Westfield this go around. And then jumping into the global equity managers, which are the ones that are really sort of causing the issues from an active underperformance standpoint. Walter Scott being one that we're recommending replacing. This is one, in contrast to the impacts in Lindsay Train, has been in the portfolio for a while. So we feel like we've given them enough time to really show over a full market cycle that they can or can't underperform or outperform. And in this case, they're not performing within our expectations. And so, we're recommending this, and obviously our research team, as I mentioned, have done that re-underwriting process and downgrading them appropriately. So Kelly will talk about that here in a minute as we talk about the recommendation. But jumping down to Imvax and Lindsay Train, two managers that from an absolute basis and relative, have underperformed expectations. But you'll recall, these are new in the portfolio. We have 1 year, but I think it was just over a year that they were added to the portfolio. So in our view, obviously we want to see some better performance coming out of these managers, but still not quite to that time frame where giving them enough time to operate in enough different market environments to show that they can add value, particularly on the downside, and help protecting assets there. Impacts this last quarter, they had been performing right around median up until this quarter. They've had some poor stock selection more recently. However, they maintain sort of this conviction in what, quote, sort of the picks and shovel approach to AI. So they're not going to be in a lot of the big hyperscaler names that are driving markets, but maybe some of more of things like performance efficiency, things like waste and recycling, industrial gases, things that are going to be more operationally defensive businesses. So sort of out of favor that type of approach thus far. But again, as markets rotate, hopefully that adds value in the long term. We'd like to see that those performance on a relative basis pick up in the 2 to 3 year time frame. Lindsay Train, this is one that when we recommended the portfolio, we knew was going to have higher tracking error. So it's still, although it's underperforming here, it's still sort of within reason in terms of when we look at the standard deviation and what we would expect for performance. It's within bounds given the market environment, but this is one that has roughly 20 to 30 positions. They take a very, very long-term approach, like multi-decade type approach. So sort of a buy and hold approach with higher tracking error. So while not surprising necessarily, I would say more disappointing, just given the absolute numbers there. They are going to be a little bit more value oriented, and where they tend to outperform are going to be in the slower or maybe no or declining growth periods, when sort of higher quality, less cyclical companies are going to be in favor. And in particular, that usually means when value outperforms growth, which for a long time hasn't really been the case. So again, maybe give it a little bit more time to see how they perform in maybe a market environment that's rotating into something that's more favorable for them. So shifting down to the bottom of the page, the international markets, a great place to be, as we mentioned. Silchester has had strong absolute performance and performing well, in the past 6 months, despite some of the value tilt there. Still ranking really well. You can see the Q4 ranking, in the 15th percentile. So really comfortable with that manager. Then Acadian, like the two global equity managers new to the portfolio, performing sort of in line with its benchmark. It's going to underperform slightly just due to its small cap tilt. And then this type of market, large cap emerging markets has done better, but still no concerns with that manager here. And then onto the fixed income on the next page. This has been, a real strength of the portfolio. The idea here is you're going to construct one that's hopefully outperforms the U.S. ag over the long term, and generally, outperforming in all time periods, except very slightly in this last quarter, but still ranking really well over the 10-year time period. You can see the 27th percentile. A lot of that due to some of your, what I'll call more active type managers in BlackRock, SIO, and Bain. You can see the Bain number, that 3-year up 9%, which is obviously really good for a fixed income type portfolio and could be an area that we may use the funding sources that's run up. And then finally, that income research and management bonds, which is that IRNM position that has been added to all 3 portfolios. In this particular portfolio, it replaced what was common fund here. So no performance yet, but we would see that on future performance reports. And then towards the middle of the page, Newton, outperformed in Q4, ranking really well in the top quartile here. This is an area or a manager that's going to sometimes have some underperformance and sometimes some outperformance, obviously, but ultimately they've done really well and sort of in line with their benchmark over the long term. Q4 in particular, both of their sort of strategies worked well, both the return seeking as well as their sort of more stabilizing layers. And really the only thing that didn't work well was the hedges, because everything was up thus far in 2025. So, and then rounding out, Lighthouse, very similar to Newton, being a long short manager, ranking a little bit below median over the long term, but performed really well in Q4. You can see outperforming its benchmark by about 70 basis points and above median relative to its managers or to its peer group. And then Landmark, the lone private markets fund in the portfolios. We've talked about this before. This isn't the best way to view a private markets performance. This is time-weighted returns. So we do have later in the book the internal rate of return, or IRR, which is a better measure of performance. And under that, it was performing about 10.2% since inception as of June 30th, and in line with other managers of similar strategy. And then finally, I think there's a couple of managers that aren't in that portfolio that are in the others. The first one being Principal in the pension fund down here, up about 1.1% for the quarter. So this was another good quarter following a really strong Q2 and Q3 for Principal, and helping bringing their long-term performance back into line with its benchmark. And then PIMCO, I believe, in the operating fund towards the bottom of this page here, was the final manager. They outperformed again in Q4 and in all trailing time periods. This is going to be pretty different than their peers, having sort of a 60. Most peers are going to have sort of this 60-40 portfolio with 60% equity, 40% fixed income. PIMCO is going to have a little bit less equity exposure, but despite that, they performed pretty well here. Q4, they had some exposure to international developed and emerging markets, which, as we saw, were the best performing asset classes in 2025. So good performance coming out of PIMCO, and would like to see that continue going forward. I think that rounds out the performance discussion. Unless there's any questions, we can shift gears to the asset allocation. I'll let Kelly take over from there. Great. Well, Kelly.
Great. Thanks, Matt. So if we can move to page 3. So the goal of this presentation was really set up to, every year at this point in time, we review the asset allocation of all 3 portfolios and determine if the current asset allocation can achieve those long-term goals, return goals that we have for the portfolios. And so before I get into that, I did want to kind of take a step back and show you kind of the capital market assumptions we have for our asset classes as of 12/31/25, because these are the inputs that are going into our modeling when we look at your portfolios. And as Matt talked about in terms of kind of, thinking back to 2025 performance, mentioned that we've seen very strong equity returns in 2025 and really over the last 3 years. We've seen a lot of earnings growth, higher valuations. And so, given the building blocks of, kind of how we put our return expectations together, which is, relied on, yield, inflation, earnings and valuations, it's, no surprise that if you look at the delta column for the equity asset classes, that our equity return assumptions over the next 10 years are down quite considerably. Just to put into perspective, large cap equity, 4.5%. This is a very low return expectation over the next 10 years. Our return expectations are assuming a path towards normalization, of valuations and so forth. However, there's volatility around these expectations. We're not showing you the volatility numbers on this page, but let's say it's around 15% volatility for large cap equity. And if we continue to see, you know, progress in the AI space and those mega cap names continue to expand their valuations and have good earnings, you know, we could see these numbers much higher. So again, these are baseline median forecasts over the next 10 years. When we look out over the next 30 years, and those are the numbers that we use for our long-term investors when we're thinking about kind of strategic asset allocation, large cap equity numbers are more in the, you know, 6% return range. So much higher when we look at the 30-year. For fixed income, our fixed income assumptions have come down a little bit, but, you know, pretty similar to what they were last year. These are more representative of kind of, you know, where current yield curves are. One thing that you'll see here is, you know, if you look at the U.S. Treasury bonds, expected to get 4.4% over the next 10 years, which is essentially the same return that you could get for large cap equities. We've had a number of clients say, well, why would I take the risk in equities if I can get the same return in a lower risk asset class? Shouldn't we move to more fixed income? And we're counseling clients to stay the path, stay with your long-term strategic asset allocation unless your risk tolerances have changed dramatically. But we do still believe that there is equity premium versus fixed income. And again, looking more to our 30-year assumptions for that. So I just wanted to point that out on this page before we get into the portfolios. If we could move to page 4. As we look at strategic asset allocation for our clients, we look at this every year, but typically you don't see very wide or dramatic shifts in asset allocation every year from us or recommendations. When we look at kind of our outlook for this year for strategic asset allocation, we're counseling clients, you know, in their equity portfolio to maintain exposure to U.S., international, and emerging market equity, kind of at the weights of the MSCI All Country World Index. And that's something that has been adopted in the University of Maine system portfolios, the MIP and the pension for quite some time. So you're in line with that outlook. And then the third bullet here is just maintaining a distinct asset allocation within fixed income across high quality fixed income, safe haven fixed income, and return seeking fixed income. So for example, in the managed investment pool, you know, that safe haven fixed income with treasuries, the high quality fixed income with managers like IR&M in the corporate bond space, and the return seeking fixed income with Bain and BlackRock, and more of the higher yielding type fixed income space. And then, you know, we're starting to say, you know, if we do, you know, inflation is one of the biggest risks that still is out there. And as Matt mentioned, the market is really not taking into account. And so there is some potential to add real assets to portfolios. You do have real asset exposure in your portfolios in an indirect way. One being through Newton. There's some, you know, gold exposure and some diversifying assets in that manager. Through PIMCO All Asset, they do invest in things like commodities and natural resource equities. And then you do have a little bit of that real estate exposure in the pension. So you are accessing some diversified real asset exposure, but not in a strategic target way per se across the portfolios. So if I move to page 8, we struggled on how to really present this presentation because there's a manager recommendation, and if you approve the manager recommendation, it has an implication for an asset allocation recommendation, really, in the MIP. So I'm going to start with this and then move into the asset allocation. But as Matt kind of preluded, we are recommending that the committee consider terminating Walter Scott. The manager is both in the MIP and the pension. This has been in your portfolio, as you saw in the performance review, for 5+ years. And as you saw, performance has struggled, mostly due to the quality bias. They've had asset outflows, which is not at a level that is concerning at this point in time. But there, we are starting to see asset outflows, and our research team believes that could hinder future alpha potential. And as Matt mentioned, we have downgraded the strategy to a 3 rating, which is a neutral rating. It is not a pure, can't hold it in your portfolio. You need to absolutely terminate it, but we have lost conviction in the manager. And so with that, recommending termination. Within the managed investment pool, again, this goes back to my comment of kind of if you do terminate Walter Scott, it also kind of triggers an asset allocation decision. So, there is opportunity in the managed investment pool to reallocate Walter Scott's assets. Walter Scott is a global equity manager that invests in large cap, international developed and emerging equity. And you can take those assets and reallocate to those managers, and which are all fossil fuel free managers. And I should state Walter Scott is not a dedicated fossil fuel free strategy, but historically and potentially will not invest in fossil fuels ever. They have a 0% exposure. So we can reallocate assets there. I will stop because I see 2 questions, and Elise, I think your hand was raised first, so I'll take yours first, and then Jack, I saw you second.
You answered my first question, and Matt, thank you for all of the background that you gave as well. How long has Walter Scott been in the 3 category for you? I know you said that we've had them for 5 years, but how long have you had? I know you said it's neutral, but how long have you had, I guess, these concerns?
So I believe Walter Scott was downgraded during Q4 of 25.
Okay, thank you.
Yep. Jack?
Thanks very much. How has Walter Scott done relative to quality peers? So is it the strategy that's underperforming, or are they underperforming as well?
Sure. So we show them versus the broad global equity peer group, not specifically just quality peers, but their rankings have been below median overall trailing time periods. Their underperformance is really coming from owning a lot of stocks in the healthcare sector and the consumer discretionary sector, particularly like luxury goods, Louis Vuitton, Ferrari, and then having a very overweight to healthcare, which has not been in favor. So part of their underperformance, versus peers and the benchmark is not holding, a lot of that Mag 7. But again, not only is it the performance, but also some of the other things that we're seeing in terms of kind of firm outflows and things of that nature. And doing our full investment framework on Walter Scott, our research team has lost conviction across the board. So it's not purely performance.
Right. I manage small endowments, and we're actually leaning into quality now, and which leads to my next question of the Magnificent Seven. Do you monitor exposure there? I imagine it's de minimis. It's probably 22% of the ACWI index, but we have so many alternative options that it's probably like a fraction of that. Do you monitor that?
Indirectly. So there's about a 15% 15% allocation to the S&P 500 index, and 35% of that would be in the Mag 7. So call that, 5% exposure just in that one investment. Would not have any with Walter Scott, none with Impacts. I would say none with Lindsell Train, so it's about a 5% exposure at the total plan level, just in that one SSGA S&P 500 investment.
Okay. Well, what's NEPC's posture on just the concentration and the CapEx and whatnot? It seems like it's a pretty big part of the market now.
It is a big part of the market. We've been counseling clients to not have no exposure to it, but diversify away from it across the board. And I think that is encompassed in the managed investment pool today across, having the international developed emerging exposure and things of that nature. So again, You want some exposure just because you don't want to, be completely off base when those stocks are going up. But again, you want to be considerate of the valuations that we have there and kind of what we're seeing in the first quarter of 2026 when those investments can go down.
Yeah, great. Thanks very much. Good to see you.
Good to see you too. So I went through the MIP and the recommendation there to reallocate assets to large cap, international, and emerging. And we'll look at that, what that looks like in a moment. For the pension, the asset base is smaller there. So in the pension plan, if you remember the performance slide that Matt was going through, the equity exposure in the pension plan is just across those three global managers, right? We have about $15 million in pension assets. It's hard to get, individual line items at a sizable amount that, it can be invested at some of these managers. So here we are recommending that you replace Walter Scott with an MSCI ACWI fund. So you still get the large cap, international, and emerging exposure, but all combined together in an MSCI ACWI index fund. iShares, sticking with your fossil fuel divestment theme, iShares does have a low carbon MSCI ACWI ETF with the ticker CRBN that can meet the system's divestment goals. So our recommendation there is a manager change, not an asset allocation change. And just to note with the committee, this product isn't essentially rated at NEPC, but generally we are comfortable with iShares ETFs and that platform across the board. So just to want to state that for the committee that this product does not have a rating on it, but generally comfortable with the iShares platform and have used iShares ETFs in portfolios. So if I move to page 9, this is the MIP. And so again, if you decide to terminate Walter Scott, if you look on this table here, on the left-hand side are all the asset classes that's currently in the MIP today, and about 5 rows down is global equity. In your current policy, you have a 30% allocation to global equity. That's a 10% allocation to Walter Scott, 10% to Impacts, 10% to Lindsell Train. So if you look in the recommended policy column there, global equity would move to 20%. So removing the Walter Scott allocation at 10%, maintaining Lindsell Train and Impacts. And then if you bring your eyes up, you'll notice that if you compare the numbers in the current policy column to the recommended policy column for large cap, small cap, non-US, and emerging equity, you'll see that those percentages change a little bit. So again, we kept the current weightings between all these asset classes as a total percentage of equity and just kind of reweighted that 10% across the board, maintaining those targets to be in line with the MSCI ACWI. The rest of the information on the table in terms of fixed income and total multi-asset is the same in both columns. And what you can see at the bottom, again, between current policy and recommended policy, just because we're moving around the same asset classes, there's no change to expected return or risk across the board, whether you stay with your current policy or the recommended policy. The one thing I did want to point out, again, another reason why we do these asset allocation reviews in the beginning of the year is that we want to see if the asset allocation can support the return goals for the system. And this portfolio has a return goal of 7.25%. And as I mentioned earlier, for long-term portfolios, we look at the 30-year expected return assumptions. And you can see that those expected return assumptions range between 6.8 and 7.9% on a beta only assumption. So from our perspective, and we write memos to Tracy to pass along to the actuaries every year. From our perspective, we believe that the asset allocation can still support that return goal. On the next page is the pension fund. Again, here, no recommendations on asset allocation because a manager change within global equity is not triggering us to make a recommendation on asset allocation. Additionally, looking at the bottom of the page and we look at our expected returns over the 30-year, it ranges between 6.4% at a median level to 7.1% if we look at the 68th percentile. So that range of 6.4 to 7.1 from our perspective can support the goal of the pension fund's return goal of 6.25. And then lastly, for the operating fund on the next page, the majority of this fund is invested in cash and fixed income, with just a little bit in return-seeking assets at around 22%. You can see over the next 30 years or so, actually a pretty decent return on this portfolio that's very conservative, ranging between 5.3 and 5.6%. With a standard deviation of only 3.7. So in a one standard deviation event, it's really not expected that the operating fund would lose money because the return is above that standard deviation, and that the range of returns in the mid fives can more than support the return goal of 4% for the operating fund. So I'll stop there and see if there's any questions. Again, our recommendation to you all is to terminate Walter Scott in both the MIP and the pension within the managed investment pool, to use those proceeds to allocate to large cap international and emerging market equity managers through that asset allocation change. And then in the pension fund to terminate Walter Scott and reallocate those proceeds to the MSCI ACWI Index iShares ETF fund.
Excellent. Any questions for Kelly or Matt? Great presentation. Thanks again for your partnership and your expertise. And I'm gonna move forward to the text of the proposed resolution if we don't have any questions or concerns. Okay, so that the Board of Trustees, acting through the Investment Committee, approves the following asset allocation changes and manager recommendations. The managed investment pool, terminate Walter Scott Global Equity in the managed investment pool and use the proceeds to increase the large cap, international developed, and emerging markets equity allocations. And in the pension fund, terminate Walter Scott Global Equity in the pension fund and allocate the proceeds to iShares Low Carbon MSCI ACWI ETF, a global diversified fund. Any questions or discussions? Hearing none, can I have a motion?
So moved.
Second,
Okay, who moved it?
David moved.
Oh, Trustee McMahon moved.
Yep.
And Trustee Riley second. And Beth, I'll transfer to you for the roll on the
Okay.
motion.
Trustee Martin,
Yes.
Trustee Riley,
Yes.
Trustee McMahon,
Yes.
Trustee Moore,
Yes.
Trustee Baldacci,
Yes.
Trustee Worth.
Yes.
Motion carries.
Excellent. And we're at the end of our meeting, 4 minutes shy of 3 o'clock. And it was a good meeting too. I enjoyed all the questions and communication. So I thank everybody for that. Our next meeting is May 7th at 1 p.m. And I'm going to see some of the board members. I'll see you and Tracy and Beth, I'll see you at the March meeting on the 15th and the 16th. And just a little plug for the Can-Am International Dog Sled Races. If any of you guys are bored and want to come see an amazing race, just head north. I know it's a long drive, but downhill on the way back. So,
And thank God there's snow.
yes, there is snow, but it's supposed to. Unfortunately, it's going to be 41 degrees for the takeoff. But the good news for the dogs and maybe not for the mushers, but for the dogs, it's going to go, sub-zero temps after the first day. So it's always a good time.
Have fun.
All right. Take care. Thanks for the great meeting.
Thanks, Kelly.
All right. Take
Bye,
care.
everyone. Thank you.